This World Liberty financial story is not just another token dump. If what we're seeing is really what it looks like, then this is a project using a barely liquid token to pull out a massive liquidity, while one signer can freeze holders. Justin Sun is now openly attacking the project, and this could absolutely end up in court. So today I'm going to break down exactly what is happening, why the scandal matters, and why, in my opinion, this is one of the most worrying stories in crypto right now. Hello everyone and welcome to Crypto Red, the crypto news channel. We have a lot to cover today, but clearly the main subject is World Liberty Financial. We also talk about strategy continuing to buy an insane amount of Bitcoin, Bitmine accumulating more and more Ether, and post-quantum transaction workaround for Bitcoin. We're also going to talk about StarkWare, Aave, Polkadot, and a lot of other subjects. Hello everyone, welcome to Crypto Red. And a lot have been asking me what is going on with World Liberty Financial. The token has been under pressure. There is a real scandal building around this project. Justin Sun also is talking about this, so let's break it down properly. First, the token. If you zoom out a little bit, the performance is not amazing at all. It's still sitting at a pretty elevated valuation, though we're talking about to FDV close to $8 billion, which is enormous, but there has been a huge drop since the launch of the token. But over the last few days, the token has clearly been under pressure, and the key trigger appears to be revelations around the very large loan linked to the team behind World Liberty Financial. And that's where things start becoming a real problem. Just a reminder, World Liberty Financial is the project associated with Donald Trump. His sons are involved and the profits flow toward the Trump side of the structure. I also went back to look at the token structure itself, and one thing I want to say very clearly is that as far as value capture is concerned, the WLFI token does not look attractive because it does not capture anything. If you go back to the original white paper, around 75% of profits were set to go to the Trump family side and around 25% controlled by another entity. So from the beginning, the design was not really about sending value back to the token holders through buybacks or some strong value accrual mechanism. That matters because if a token doesn't capture much value, then it's not really a token that can attract value long term. It's only a narrative-based token. And when the confidence starts to crack, there's not much underneath to stabilize it. But the main problem right now is not even that. The main problem is the loan. According to multiple reports, the team behind World Liberty Financial took a very large loan on Dolomite. Dolomite is a DeFi app. Some source put it around $160 million in USDC. Now, why are we talking about Dolomite? Because Dolomite is not just a random third-party app. It was built by someone linked to World Liberty Financial, some advisor to World Liberty Financial. I haven't heard it was its CTO, so it's really someone linked to WLFI, it's really worrying me because what was the collateral for the loan? The collateral for the loan was the WLFI tokens, and that is the core issue. They reportedly posted hundreds of millions of dollars worth of WLFI token as collateral in order to borrow stablecoins. But the problem is that this collateral is not truly liquid. If they want to dump it, then they will dump it with a huge discount. But if you sell it on the open markets, the market's going to collapse. So what does it mean? It means that you can create a situation where you mark an asset at an impressive headline value, use it as collateral, extract real liquidity against it, stablecoins, but the collateral itself cannot realistically be sold without imploding the market. And that's the issue. This is why I find this story so worrying, because if that reading is right, then this is a way of creating liquidity out of a token that is not properly liquid. You are not selling it directly into the market, but economically you are still pulling real dollars out against it. And where do those dollars come from? They come from users of Dolomite. They come from people depositing USDC and similar assets to earn yield. And that's why the yield can look attractive on Dolomite. But people need to understand what the other side of the trade is. If you deposit stablecoins into a protocol like that, and a giant borrower is taking funds against collateral that can't actually absorb liquidation pressure, then you are taking a very different kind of risk than many users probably imagine. And this reminds me a little bit of the old CRV situation when Michael Egorov, the boss of Curve Finance, had deposited massive amount of CRV and borrowed against it. But there is a major difference. In the CRV case, you could say he was exploiting risk parameters that another protocol had allowed, that Aave had allowed. Here, the concern is even worse, because the protocol doing the borrowing and the ecosystem behind the token look deeply connected. So it feels less like someone took advantage of market inefficiency and more like the structure was there to make this possible. And this is why it's, like I said, it's really worrying, because if World Liberty Financial borrowed something like $160 million against collateral that cannot realistically be liquidated, then what exactly guarantees the repayment? They haven't really shown a credible repayment path that does not depend on assumptions that are very fragile. If they try to unload WLFI to repay in a stress scenario, they would crash the market. So what is the plan? That's the real question, and there's no robust answer given by WLFI. And I'm also worried about Dolomite, the DeFi app. If you are lending USDC into a system where the main borrower is huge and have a huge collateral that is not liquidable, that can be liquidated easily, then it can be a huge problem. And now World Liberty Financial tried to claim that to calm the markets, they said that they have repaid part of the loan, around $25 million. And on the surface, that sounds reassuring. But even here, people start asking more questions. CoinDesk asked more questions because at roughly the same time, they also minted around $25 million of USD1, their own stablecoin. So naturally, people immediately start wondering, wait, did they just mint their own stablecoin and use that directly or indirectly to repay their debt? Now, to be very clear, that specific conclusion is speculative. I want to be precise here. I'm not saying this is proven, but I absolutely understand why people are asking the question, because the sequence looks suspicious. And from what I've seen, when journalists ask for clarification and the answer are not really clear, yeah, it could be an issue. So yeah, in theory, the USD1, the stablecoin, is fully sound. It's a good stablecoin. It's BitGo is involved in the custody side with attestation meant to provide visibility into the backing. And I want to check, in fact, the attestations. I did not see the March attestation, but yeah, that's not a huge issue because we're still in mid-April. But yeah, so let's move on to the second big point in this story. It's Justin Sun. Justin Sun has now stepped into this fight, and that adds another layer of drama into the entire situation. He starts raising alarms about what he believes is going on at World Liberty Financial. He essentially suggested that users' money is being used to serve the project's own interest. And whether people like Justin Sun or not is almost secondary here. What matters is that someone who had major exposure and helped legitimize the project is now openly criticizing World Liberty Financial. When he got involved, there were very few believers in World Liberty Financial. The ICO had been live for a while and was not exactly flying off the shelf. Then Justin Sun came in early, put tens of millions of dollars into the project, and that changed the perception. So then suddenly more investors and more people paid attention. Then you had the Trump political momentum, the brand effects. So Justin Sun was not irrelevant in this story. He helped make World Liberty Financial what World Liberty Financial is today. And now he's angry. Why? Because he says his tokens are still blocked. And this brings us to the most shocking governance point in this whole story. There was some analysis suggesting that yes, there is a multi-sig structure involved, but for blacklisting the token to prevent users from moving their token, there is no committee. Only one address can move the tokens. One simple Ethereum address can block any World Liberty Financial user from moving their token. And this is a big red flag. How can you seriously present something as decentralized if one signer can freeze people? People will say, yes, but USDC and similar assets also have blacklist function. It's true, but USDC does not pretend to be a decentralized governance token representing some crypto freedom movement. It's a centralized stablecoin. It's a transparency, and yeah, people know this. But here we are talking about the governance token that has a blacklist function that a single user can activate. So yeah, Justinson is obviously fierce because he's blocked from selling himself because he was one of the people, like I said, who was backing the project since the beginning. But they say that he sold some token that he did not have the right to sell, and that's why they blacklisted him. So yeah, the token, in my opinion, does not do much in terms of value capture. The governance optics looks really bad. The centralization concerns are serious. The collateral issue is deeply uncomfortable right now, and now you have a major backer publicly fighting the project. This is not the kind of mix that ends well. And then you have the rumors around the stablecoin issue, where they could be minting their own token, but to repay their debt. But as I said, this is only a rumor. So yeah, let's move on to the other stories because there are a lot of other stories. First, Strategy. Strategy has bought more than $1 billion worth of Bitcoin again. This is massive. They continue to accumulate aggressively, and they are doing it largely through the STRC structure, which allows them to raise money without straight common shares dilution. So yeah, they're offering investors a fixed yield at around 11.5%. And I also want to be clear right now, this yield worries me a lot. I really do not like it. An 11.5% yield in that context does not feel durable to me. I would not personally recommend buying a STRC for that yield. I think there's a real risk that the market price of the instrument diverges from the implied stable reference, the $100 stable reference. In other words, people may focus on the yield and forget that market pricing can move against them in ways that they do not expect. So yeah, Strategy continues to raise huge amounts of money. This is good for Bitcoin in the sense that more capital is being used to acquire BTC. There's no question that this buying pressure supports the asset, but that does not mean I like every layer of the financial structure equally. So yeah, those are two different things. Good for Bitcoin, yes, but would I tell people to chase that yield blindly? Absolutely no. Now, on the Ether side, Bitmine has now crossed over the 4% threshold of all Ether held, which is insane. Less than a year ago, they were talking about eventually targeting 5%, and a lot of people thought that sounds crazy. Honestly, I even did not think they would get to 5% that quickly, to 4% that quickly, and this is huge. So clearly, they are executing on their plan. But here again, I have mixed feelings. On the one hand, it's a very strong signal of confidence in Ether. It's a good in the sense that large capital is aggressively accumulating that asset. But on the other hand, concentration start to bother me a little bit. If we start moving towards 6%, 7% and beyond, I think that become uncomfortable. At some point, the accumulation itself become part of the risk conversation. So yeah, it's impressive. Yes, it's bullish in some ways, but I do think that there is a threshold where it starts to feel like too much concentration. Now let's go back to Bitcoin and the quantum computing topic, because I've been talking about that quite a bit, and there was some genuinely interesting development this weekend. A paper came out from someone associated with StarkWare showing a way to create post-quantum Bitcoin transaction without a soft fork and without waiting for a protocol level Bitcoin upgrade. And this is basically a workaround, the hacky workaround, but it's still a workaround. The idea is to use Bitcoin stack in a very unconventional way with off-chain computation and structure that allows funds to move from an address into a quantum-resistant setup. It is not really elegant, it is not cheap, but it exists. And that matters because one of the biggest criticism around the Bitcoin quantum risk discussion is that people talk endlessly about the problem without doing stuff. And here, this developer just presented the solution. But the downside is cost. He estimates the people will likely have to spend between $75 to $200 per transaction, depending on the assumption on the computation involved. But yeah, this is a lot of off-chain work, a lot of GPU heavy processing. So this is obviously not something normal users are going to use for everyday transfer. If you have $400 worth of BTC, you're not going to spend half just to make a post-quantum transaction. That's absurd. So yeah, this is not the long-term answer, but and also the performance implications are also terrible. The transaction sizes are very large. If Bitcoin transaction had to work like this broadly, the output would collapse. We're talking about something far below 1 transaction per second in that kind of setup. More realistically, something like 0.3 transaction per second or 0.1 transaction per second. But I still think this is good news because it gives us a contingency path. It shows that people are actively working on the problem. It proves that the conversation is no longer purely theoretical, and it reminds everyone that solutions do not always have to come directly from the Bitcoin core team. External researchers and builders can produce tools that users may adapt if needed, and this is really valuable. Let's talk about let's talk about something else. Let's talk about StarkWare, the company. The company has just announced a reorganization. They're refocusing around two main teams and they're cutting staff as well. They didn't give the full numbers, but clearly layoffs are happening. And yeah, this is not surprising. StarkWare has been around for a long time. They have serious technology. They started with Ethereum. They pushed hard around ZK technology. They've worked on things around Bitcoin more recently. They've also touched the cash-related ideas. But if we're being honest, they still haven't produced that breakout product that attracts massive user adoption and the scale many people expected. So when a company like that reorganizes, it usually means management has concluded that something needed to change. And I think that's fair. The market has changed. Narratives around Bitcoin, around Ether have changed. So yeah, user behavior also have changed. So yeah, it's logical that they have to change something also. Now let's move on to Aave. The controversial proposal, often referred to as Aave will win, has officially passed with about 75% support. This is very significant because it led to the exit of some major contributors and teams around the Aave ecosystem. So yeah, now Aave Labs and Stani are in even more dominant position around the direction of the project. And the way I see it is the central issue here is not whether Aave is currently a good product. It is. There's no need to deny the reality. Aave remains one of the strongest projects in DeFi. My concern is more long-term. As I understand the logic of the proposal, all revenues generated by Aave products will go throughout the DAO structure. While Aave Labs receives a package that includes stablecoins and Aave tokens, and the bigger concern here is governance power. If one side can repeatedly push through the proposal it wants, then over time it can shape how value is extracted, distributed, and captured. And that matters a lot because in DeFi, long-term value is heavily tied to who ultimately controls the economics. If governance becomes too one-sided, like it seems to have become with Aave Labs controlling almost everything, then the token can gradually lose some of the value capture people expect, even if the app remains operationally strong. This is why I'm not fully bullish long-term on Aave from the token perspective. And finally, last story, a smaller one, roughly 1.1 billion of DOT token were minted out of thin air in an exploit. But to be precise, this did not happen on the Polkadot blockchain. It happened on Ethereum through a Polkadot related bridge called Hyperbridge. The hacker was only able to extract around $237,000 because there wasn't enough liquidity to cash out more. So yeah, the headline number is spectacular, but the real damage was much smaller. The story is funny in almost a painful way because Hyperbridge had joked on April 1st that it had been hacked. Then they said no, they were just kidding and the protocol could never be hacked. And this is exactly what you should never say that. You should never say your protocol can't be hacked because somehow in DeFi, when a protocol acts invincible or mocks other hacked protocol, it's almost feel like an invitation. Hackers take that personally, they treat it like a challenge, and then they go after the protocol just to prove the point. I've seen that mentality multiple times in the industry. So when I saw the story, my first reaction was honestly that some hacker probably saw that April 1st post and decided, okay, now I really want to break this thing. Maybe I'm wrong, but yeah, that's kind of dynamic that exists in DeFi. So yeah, we talked about a lot of news today. Tell me in the comments what you think. Do you believe the World Bitcoin financial scandal is being underestimated or overestimated by me? If you enjoyed the video, don't forget to like, comment, subscribe, and I'll see you tomorrow for the next one. Bye-bye.